Are your existing solutions able to take advantage of real threat intelligence? Common solutions like firewalls weren't designed to handle the massive and growing volume of threat indicators. This challenge often results in significant gaps in your protections, even when you think you have it covered. You need to protect yourself by filtering network traffic against unique threat indicators in a way that allows you to act. Palowall by Bandora Systems is the solution that filters over 10 million indicators right out of the box. Developed in partnership with the Department of Defense, Palowall is affordable for companies of all sizes. Get your free trial today at bandorasystems.com. Rapid7 powers the practice of SecOps. Using shared data, analytics, and automated workflows, SecOps unites IT, DevOps, and security teams to make security an outcome of innovation. Rapid7 combines technology, expertise, and advocacy to drive vulnerability management, application security, incident detection, and log management for more than 7,000 organizations worldwide. Power up your SecOps practice with a free trial at rapid7.com/securityweekly. Welcome back, everyone, to Business Security Weekly. I'm, of course, here with Matt Alderman on the lines via Skype. Matt, our first headline to talk about in tracking security innovation is the acquisition of Bradford Networks by Fortinet. Believe we covered this on Enterprise Security Weekly. So on this show, Matt, I want to talk a little bit about the deal, right? And Bradford Networks is based in Boston, Massachusetts. Their estimated revenue is $36.9 million. They've got 200 employees, and they raised a total of $6 million in funding. I think that's pretty. I mean, just those stats alone, and granted, some of those might be crowdsourced statistics, but if they're anywhere in the range, I mean, that's pretty good. If their revenue is that, and their funding was that, and they've got 200 employees, I think that's pretty good. No?
Yeah, I think it's really good. They've been around since '99. They've been around for a while. I remember seeing these guys back when I was at RSA, kind of more in the kind of a NAC player. It looks like they pivoted a little bit more into the orchestration automation. I think it's still kind of NAC related a little bit.
Sure. But
they've been around for a long time. And so, you know, they could easily have that kind of revenue stream, having been around that long, and employee base. But only $6 million in funding, that's actually really, really good. So there's probably a pretty good exit here for them in this particular case, because they didn't take a lot of equity or investment, which means, you know, multiples are reasonable considering.
Yeah, you wonder why this was their exit, right? Like they took three equity rounds, right? $1 million, $3 million, and $2 million. You wonder why they didn't go for a big series round or take on more rather than get acquired. I'm wondering if they were struggling in the marketplace, if they're struggling to gain traction, and Fortinet is now going to give them that traction, as we talked about in Enterprise Security Weekly. It's a pretty good melding of technologies together.
Yeah, and I think this is the double-edged sword with funding, and it's something I've coaching through a couple companies through right now is when you start taking VC money, A, B, C, you have to think about your exit. And we'll talk about one of the other exits here later, in what that means from a strategic M&A perspective. Is if you take too much money early and don't have the revenue, your exits really shrink really fast. And I think there's a balance that companies have to think about here is when do you take A, when do you take a B, and what are those exit points prior to an A, prior to a B, et cetera? Because we know that Bradford probably wasn't going to go IPO. I don't know that they had a big enough market share. I don't know that they were in a big enough TAM to really justify an IPO, for example. So then you really think about, okay, where are those exit points? In maybe for them, this was the right one at the right time with the right valuation. Again, every time you take a round, your valuations change. And if you don't have the revenue to back it up, things can get ugly fast. And, again, there's another story in here that talks about aspects of this. Qualys has been really, really good at picking up companies that haven't done super, super well, but picked up some really good assets and some good intellectual property along the way by bringing that stuff in. And so, look, guys that are in the strategic M&A, they're looking at all these numbers. So you have to keep them in check as you're going through the process.
Yeah, my assessment, to move on to the Qualys story, right? They acquired Second Front Systems. Is Qualys makes very calculated acquisitions. They don't seem to like
Very.
stretch it in any capacity. Like when they make an acquisition, every time we cover, like, yeah, that kind of fits, and there wasn't a whole lot of risk involved.
But Qualys' strategy is very near its adjacency markets, always has been.
Mm-hmm.
They haven't really done anything crazy outside of a very tight domain, right? When they were in the VM space, they moved it into policy compliance and web app scanning. That gave them the foundation to build the WAF and brought in some assets back then. So each of their acquisitions are very targeted at picking up really good assets in intellectual property that augment and help them continue to expand in a very definitive way. Their strategy is much tighter, but every single acquisition makes sense for them. This one is very interesting because this is a federal play. And Qualys got FedRAMP certified, I think last year, maybe late the year before. And they're really trying to continue to build momentum into the federal space. You know, there's RFIs on the street to redo ACAS and some other things, and Qualys is making a play for that. And so this fits in as they continue to look at trying to get themselves a stronger foothold in the federal market.
Is that to try and take some of that market share from Tenable? I know at Tenable we made a lot of public announcements about how we supported that.
Yeah, I mean, when DoD put DISA put the RFI back on the street for ACAS, it was interesting. I've seen a copy of it. You know, they're really looking at just the vulnerability detection components, not some of the compliance components. Right. That means there are other players out there that can meet the requirements of that RFI. Does this give Qualys, even Rapid7 or somebody else, an opportunity to come in and take some of that market share? Absolutely. That's going to be a very competitive market. They want those government dollars.
CounterTack acquired GoSecure. Are you familiar with CounterTack? I've seen them. I haven't really dug into what they do.
Yeah, so I had this as an article for Thursday's show when I sat in for you, but we didn't cover it. We had gone, did a couple tangents, and I pulled them back, and so this is one of the stories I didn't cover. So CounterTack, endpoint detection response, GoSecure, more kind of an MSSP. Really, the marriage of these two is this managed detection and response market. I was at Gartner earlier in the week last week, and this is one of those very interesting market segments of managed security service providers and managed detection and response. Kind of, what does that market look like? I think they'll come together, where you will see the MSSPs building more MDR type services. So you take an endpoint detection response company, you take somebody that understands how to make that a service offering, and you build out some offerings. What's really interesting here is that they announced a strategic relationship between the two companies back in 2015. Hint, hint, startups. If you are looking for a strategic acquisition, you have to have strategic partner relationships. Yeah. And so typically what happens,
we were talking about this on Thursday when you were here last. And
so you bring these companies together, they work together as partners, and then they realize that, this makes sense to bring the two companies together and continue the relationship as one. This is a really good example of that in a growing market, because MDRs are starting to pick up momentum here.
Yeah. Now, the advice used to be that, would you really trust an MSSP to manage your endpoints and endpoint security and your detection and response? I think a growing trend is we're seeing that the tools and techniques are allowing that to happen, I think, much more successfully, although I'm still not 100% sold on it.
Yeah, but don't get me wrong, this market's still evolving, but it's hard for some organizations who don't have the staff to do it themselves, right? So if you have good tools, you have good processes, and you can build this out as a service offering, I think you're going to see growth in this area because it's too hard for most companies to do it by themselves.
In the management of third parties and vendor platforms, there was a $5 million round for Panorays. Haven't heard of them before, but this is a hot space right now.
Yeah, this was interesting because if you go out to Owler, there's like one employee. Right. It shows that, I don't know if this is like a brand new kind of idea, one-man show or what, but it was really interesting. In the third-party space, there's been players around this space for a long time, right? Most of the GRCs have some third-party component. You've got startups in the space like Prevalent, CyberGRX here in Denver, and others that are really focused on the third-party vendor management space. It'll be interesting to see what their unique position here is in the market and what becomes of this. But there are already some pretty well-established guys in the third-party management space. And when you only have one employee, what does that mean?
Yeah. Well, and Aller's crowdsourced, so
right.
Yeah. OneLogin has raised 22.5 in a Series C. Is that a good Series C for a company like OneLogin in this space, Matt?
Well, remember, they're competing with Okta, who's now public, and so you've got to continue to really try to figure out how you're going to put a dent into Okta. So this is single sign-on and multi-factor authentication. So it's a little interesting.
They've got both, right?
Yeah, they have both.
Yep.
Which is good. But yeah, I mean, if they need the money to continue to grow, to get ready, it's usually a good investment. It's not a crazy round C, by the way. $22.5 million into a C round, it's not crazy. That's typically you could see those in B rounds, right?
Right.
Now I think they've got 62 million in total, which means their first two rounds were 30 million. So this isn't. I don't see this as a crazy round here at all from a valuation perspective. I didn't see what the value on that money was, but yeah, it looks. They're going to have to figure out a way to continue to compete with Okta. So you're going to need money to do that.
Well, yeah, and then I mean, I think you're also competing with Duo at a certain capacity as well. If you've got the multi-factor component, and those are, I mean, those are two big players to compete in the market with. Yeah,
but I think they have to have their crosshairs on Okta at this point. I mean, either they need to get enough market because a logical exit for these guys would be an IPO after the success of the Okta IPO. Which means, you're going to have a couple public guys competing in this space. I think that's where their focus is. But yeah, they do have a little bit of Duo and those guys on the multi-factor authentication side.
Awesome. Well, that rounds out the Tracking Innovation segment and the show. So, Matt, thank you very much for hosting the show with me this week. I believe Michael is back next week. So thank you, everyone, for listening and watching. See you next time.